Welcome. Our mission today is a deep dive into Woodward Inc., ticker WWD, following their fiscal Q4 and full year 2025 earnings call.
And what a call it was. If you were watching the market on November 24th, you saw a pretty strong signal.
Oh, absolutely. This was not just a small beat. The results triggered some serious follow-through volume and a pretty sharp re-rating by the market.
Exactly. It feels like Woodward is really cementing its leadership right now, driving what they kept calling record performance. So the real question is, how do they do it, and what's the plan going forward?
Let's start right there. Give us the snapshot, the headline numbers that got everyone so excited.
Okay, so the beat was, it was decisive. Q4 adjusted earnings per share came in at $2.09.
209. And the street was looking for what, around 185?
Right around there, yeah. 183 to 186. So you're talking about a 12 to 14% surprise. That's a huge beat, and it's 48% growth year over year.
48%. That's a massive number. But was the top line just as strong, or was this all cost cutting?
No, the top line was incredibly robust. Total sales hit $995 million.
So they almost break $1 billion in the quarter.
Almost. And that easily beat the consensus of around $934 million. So 16% growth there. But here's the picker for investors.
The margins.
The margins.
Yeah.
Q4 gross margin expanded by 360 basis points. It hit 27.9%. That signals real pricing power.
Right. That level of margin expansion tells you they're executing at a really high level, especially, with the shaky industrial backdrop we're seeing globally.
Absolutely. So that leads us right into the segments. We have to start with aerospace. That's the real growth engine here.
It was the star of the show this quarter.
Without a doubt. Aerospace sales jumped 20% in Q4 to $661 million. And the margins, they expanded an incredible 520 basis points.
520. Wow. So that gets them to a segment margin of what?
24.4%. It's just phenomenal profitability.
So what was the bigger surprise there? Was it the OEM volume or just the sheer velocity of the aftermarket? Because we all know airframers are having trouble scaling.
It was definitely the services side. That's where the high margin money is. Commercial services revenue was up 29% for the full year.
29%.
Yeah. And that's all about high utilization of the older planes, right? More flying means more MRO activity. But it wasn't just commercial. Defense OEM was also really strong, up 38% for the year.
38% is huge.
It is, and part of that was new pricing on JDAMs, the Joint Direct Attack Munition Kits, that really kicked in during the fourth quarter.
Okay, that makes sense. But the real long-term story, the thing that determines Woodward's valuation for the next decade, is that shift to the new ML and GTF engines.
That's the metric everyone is watching. And management gave us a timeline. They expect repair revenue from those new-gen engines to officially surpass the legacy engine repair revenue in late calendar 2026 or early 2027.
Okay, that's a huge milestone. But they made a really specific clarification there, didn't they? About spares.
They did, and it's a crucial point. They were talking specifically about repair activity, not including the sale of spare line replaceable units, or LRUs.
Okay, let's pause on that because LRUs are key to understanding the quarter. Can you explain what an LRU is for our listeners?
Sure. An LRU is basically a black box. It's a high-value component that an airline can just swap out really quickly to get a plane back in the air. The old one then comes back to Woodward for a high-margin repair.
And management flagged that Q4 got a big sort of lumpy boost from sales of these spare LRUs, right?
Exactly. They said demand was outsized, with some customers making advanced purchases. And because that was a bit of a pull forward, it's why they were a little more conservative on the services outlook for fiscal 26.
Got it. So they're basically saying, don't model that exact level of spare sales every single quarter. That's important context.
It's the fine print, but it matters.
Okay, let's pivot to the industrial side. It saw some growth, but there were some specific headwinds everyone was watching.
Right. Industrial sales grew a solid 11% in Q4 to $334 million. Margin was 14.6%. The one real weak spot was very specific. China. On highway trucks.
So that's the noise in the numbers.
That's the noise. And they expect that piece to stay pretty muted, only contributing about $60 million in sales next year, which is flat.
So if we strip out that China business, what does the core industrial segment look like?
It looks really strong. Core industrial grew 10% for the full year, and margins expanded by 110 basis points.
And where's that strength coming from?
It's coming from their strategic focus areas.
Yeah.
Oil and gas was up 14%. Power generation grew in the mid-teens. They're deliberately shifting toward these secular growth markets like data centers and energy transition, and it's clearly paying off.
That makes perfect sense. So let's connect all this back to the big picture, the strategic story. This wasn't just a great quarter of execution. It was a quarter of major strategic moves.
It was. The theme was really content, capacity, and cash. First, on content, they acquired Safran's electromechanical actuation business. But the really big win was the new contract for the Airbus A350 spoiler actuation system.
Right, the A350 win, that's a game changer for their content per plane. How much value does that add?
It's huge. Once this new contract is up and running, their total ship set value on every A350 is expected to be around $550,000.
$500,000 per plane.
$500,000 per plane. And deliveries for that new part are scheduled to start late calendar 2028. So that's guaranteed high-value revenue for years to come.
And to handle that, they're spending a lot of money. They flagged a big spike in capex.
A massive spike. Capital expenditure was $131 million in fiscal 25. For fiscal 26, they're guiding for it to peak at $290 million.
$290 million. I mean, that's a serious chunk of change, especially when their free cash flow this year was $340 million.
It is, but it's a strategic investment. Most of that is going toward automation and building out their new facility in Spartanburg, South Carolina, specifically to handle that A350 work.
So they're literally building the factory to support the revenue they've already won for the next 20 years.
That's exactly what they're doing. And to show investors they're still confident in cash flow. Despite that spend, they made a huge capital allocation announcement.
Let's talk about the buyback. The size of it was, frankly, staggering.
It was unprecedented for this company. They blew through their previous $600 million program more than a year early.
And then they followed it up with what?
A new 3-year authorization to repurchase up to $1.8 billion of common stock.
$1.8 billion. That is management screaming from the rooftops that they think their stock is cheap relative to future cash flow. You just don't authorize a buyback that size otherwise.
Absolutely. And they plan to return $650 to $700 million to shareholders next year alone through buybacks and dividends. It's a massive green flag.
Okay, so let's shift to that outlook for fiscal 26. What are the headline guidance numbers?
They're expecting continued growth. Consolidated sales growth between 7 and 12%. Adjusted EPS guided to a range of $7.50 to $8.
And segment margins.
Pretty solid. Aerospace is guided to 22 to 23%, and industrial at 14.5 to 15.5%.
I want to dig into that aerospace margin. 22 to 23% is a little below the 24.4 they just posted. That came up in the Q&A, right?
It did. And this is maybe the most important point of the entire call. The moderation is purely due to mix shift.
Meaning more OEM sales versus aftermarket.
Exactly. OEM sales are crucial for building the installed base for the future, but they just have structurally lower margins than services.
So they're consciously taking a slight hit on incremental margins now to secure decades of high-margin repair revenue later.
It's the classic compounder strategy. You sacrifice a little now for a much bigger payoff down the road. It shows incredible strategic discipline.
And are they still getting pricing power?
They are. They expect about 5% price realization across the whole portfolio in fiscal 26, which helps protect those margins.
So you put it all together, and it explains that market reaction. The stock was already near an all-time high, and it gapped up over 12% on huge volume.
The market voted with its wallet. And the options activity was telling, too. Out-of-the-money calls were up like 140%.
Mm-hmm.
The smart money is betting this aerospace upcycle has a long way to run.
Of course, after a run like that, you always hear the valuation debate. Where does that stand now?
Well, the forward PE is now over 40, so you're paying up for that growth. The expectations are definitely baked in. But the sell side is still overwhelmingly positive. One analyst raised their target all the way to $345.
So high expectations, but management is doing everything they can, from the capex to the buyback, to show they can meet them.
Precisely. They are building for the future, literally.
All right, we've covered the numbers, the strategy, the market. Let's shift gears. Let's get a little more speculative. This is not financial advice.
Always do your own research.
Okay, so the pitch here is that the market, and maybe even management's own guidance, is underestimating the speed of two things. One, that AEP and GTF MRO crossover, and two, the impact of that new A350 content.
The idea being that the EPS guide for 26 is a little conservative.
Exactly. They're sandbagging a bit because of that lumpy spares dynamic we talked about. And that $1.8 billion buyback, that's management telling you the real long-term FCF potential is way higher than what's priced in today.
So what's the actual trade idea?
The trade is to go long WWD with the thesis that they hit the high end of that $8 EPS guide or maybe even beat it. The plausible but outrageous angle is that as they spend that capex in Spartanburg, the market starts to model that $550,000 A350 ship set as guaranteed FCF much sooner.
So you're betting that the market's perception of the MRO cycle accelerates, and it pulls forward the valuation.
Right. And that's what could push the stock toward that $345 analyst target much faster than anyone expects.
It's a high-conviction play on the aerospace compounder thesis, plain and simple.
At the end of the day, Woodward just reinforced its position as a top-tier aerospace supplier. They're navigating the industrial side well and making these huge, smart investments for the future.
The takeaway really is that the Spartanburg facility and the acquisitions, they aren't just expenses. They are the foundation for future cash flow, positioning them perfectly for this multi-year aerospace upcycle.
And here's one final thought to leave you with. Management was very clear that those big spare parts sales in Q4 were non-recurring. But what if they're wrong? What if global flight utilization stays so high that airlines are forced to make another lumpy, unforecasted spare parts order in fiscal 26?
That would be pure, unguided upside.
Exactly. Could that be the surprise catalyst that pushes the stock to that 345 target even faster than the bulls expect?
That is the short-term opportunity to watch. Thanks for joining us for this deep dive. We hope you feel thoroughly informed.